Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Michael Fairborn, who is here with me, and he is already taking charge of the chat. Welcome to all of you that are here with us today in the live version, also those that might be watching this in the recorded version. Thanks for joining us and thanks for being a part of the discussion. We're going to get right into this mix here this morning because there are some things moving. We're going to take a look at some energy futures. We're going to also take a look at some metals futures, a trade that we initiated last week, and see how that's performing. And we're going to continue our dive into the active trader ladder as we get into this discussion today. But a couple of quick housekeeping items that we need to take care of before we get started. Remember that everything we talk about is simply for illustrative and educational purposes only, is not a recommendation, excuse me, of any particular strategy or idea or account type. Also, remember that futures and futures options trading involves substantial risk. It's a highly leveraged product. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of those products before trading any or considering any futures strategies or futures products. Make sure you read the risk disclosure statement for futures and options before doing that. Remember that futures accounts require separate trading authorization and are not suitable for everyone, and not everybody will qualify for a futures trading account. Also, remember that as we talk about these trades today and we look at these examples and we discuss these strategies, we're going to be using the Thinkorswim desktop software platform. It is a great learning environment. We're going to be using the paper money version of it specifically. It's not a guarantee of future success out there in the real world, and there are some differences, so be aware of those as you move from paper trading to live trading, as you move your practice to a live market. Also, remember, we're going to be using technical analysis primarily in our discussion today. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. And remember that investing involves risk, including the loss of, in cases of futures contracts, sometimes more than your initial investment. Also, remember that stop orders that generate a market order will be worked as an exchange-designated limit order within protection points. They work a little bit differently than stop orders on equities. So we'll take a look at that as we get into the discussion as well. But let's do this. Let's pop over to the Thinkorswim desktop software platform really quickly here, and let's take a look at what's going on in crude oil at the moment. This is the /MCL. This is the micro crude oil contract, the smaller crude oil contract. If we pop open our left-hand side of our futures movers grid, which we've discussed before, we can see the size and characteristics of this particular contract. Tick size is 0.01, which means that this last digit 2 to the right of the decimal point is our significant digit. That's the one that we're going to be paying attention to for a change. Every time that changes, that's $1 in terms of the notional value of the contract. The point value, if this moves from 6.5 to 6.6 or from 6.5 to 6.4, that's $100 in the value of the contract. Our notional value, this amount times this, gives us our notional value in the contract. That one's really easy to see because it's $100 times whatever that current price is. That gives us our notional value of the amount being controlled. Our initial margin, however, in the trade, if we come down here and we look at our futures list, we're going to go to our drop down and we're going to find /MCL. There it is. Our initial margin in this case is right around $574 in this micro crude oil contract. If we were to look at the big crude oil contract just really quickly here as we're looking through this, let's come down to where is it? /CL. There it is right there, /CL. You can see that it is 10 times that that initial margin of the micro contract. So the micro contract 1/10 of the large contract, the initial margin in that crude oil contract, the large contract 5,716, which is less than the notional value, so still leveraged. But the notional value of that large contract is pretty substantial. So we'll talk about that as we get into this discussion. We're taking a look at the /MCL. the micro contract here. The idea being we're maybe seeing this resistance. It's touched this resistance once and twice and 3 times, started to bleed up above that resistance a little bit. And if we shift this to our shorter term contract or our shorter term view, this is a 5-day, 5-minute, or today's 5-minute view. What I was looking at here is this potential for continued downward movement. And you can see this line right here at the 65.13 level corresponds with this line right here on the 1-year daily chart. So my expectation is a bounce down from this diagonal resistance and a move down through this support level at the 65.13. So looking for that bounce down from the resistance and a move a little bit lower. Yeah, and George, you're absolutely right. I mean, the micro contract controls a tenth, basically, of the larger contract in terms of the number of barrels of crude. So 100 barrels is 42 gallons times 100, to give you the number of gallons of crude oil in that contract. The large contract is 1,000 times 42. So 42,000 gallons in the large contract. So that's how you can keep track. And that's also how we can do equivalents when we talk about other distilled products and things. So what I'm looking for is this bounce down, and we're starting to get it right now on this 5-minute candle and the move lower. So what I'm going to do is I'm going to create a trade that is not limited on the downside. I want this to move to the downside, but I want to put in a point of protection here, an exit, potential exit. Because remember, these are going to be worked as exchange designated limit orders, and there's the potential that they may not get filled. But I'm going to put in an order to exit the position if it goes back up above this short-term high, which is right up here around 65.73. So what I'm going to do is, in this particular case, I don't care if it continues to move to the downside. That's, in fact, what I want. And I maybe want that to move over multiple days. So in this particular case, I'm going to right-click, and we're going to sell custom with stop. And in this case, we're going to create that stop up here at around 65.73. That's where my stop order is going to be in place. But because this is going to be a market order, we'll do it 65.73. Now we're looking to buy this contract back if it in fact goes up above that resistance level. No guarantee that it will, but as we take a look at this, we're going to put that in as a good till canceled. We're going to put this order in, and we're going to sell this contract looking for downside move. I'm going to do one other thing after we put this trade in place, and I'll show you what I want to do with the next part of this order. So I'm going to create this order. I'm going to read through the order, selling one contract at 65.51 limit to open. And we're kind of sitting right there, 65.53. If I can sell it at 65.53, cool. That's the process. I mean, there is a cost to trading, right? So you've got to take that into account and be aware of that. But our initial margin in initiating this position is going to be designated here, shown in our buying power effect. Right, so that's going to be our initial margin. I'm going to put this contract in our futures group. We're still there within our limit price, and I'm going to go ahead and I'm going to click on send, and we're going to fire this order off. And we've sold that contract. Now we're looking for this move to the downside, and the reason I have this level in here, and if we go back to that longer term chart, you can see where that is now, kind of that transition point, support, kind of in that support area, support here. It was a break there. It's been resistance, resistance, resistance. So that 65.13 is, I mean, we might even call it 65 as an even number here, but I'm going to call it 65.13 in this case. That's kind of a toggle point, right? That's a technical toggle point where if it stays above that level, maybe we see a bounce higher. If it goes below that level, we might see a significant move to the downside. So I want to know when that happens. I want to know when that break occurs, if it does. And if it doesn't, then I want to be able to exit this position. You can see the position is already starting to go against me a little bit, but we've got our protection order in place there to take this off. What I'm going to do is I'm going to come down here to this 65.13 and I'm going to create an alert. And I'm just going to create a single alert. And that alert is going to say, all right, fine. If this moves to or below this level, that 65.13 level, then let me know, right? Send me ring a bell, send me a text message, whatever reasons or whatever ways that I want to have that alert me. I want to know if this goes down below that level, because in that particular case, I'm going to look at continuing to make that move. I'm going to keep that trade on and follow along to the downside, right? And we click on create. There's our alert. It's already starting to move against us here. So I'm also going to put an alert up here just so that I know. I'm going to go ahead and I'm going to create an alert at this level as well, 65.75. And if this goes to or above that level, I want to know as well. Now, likely, I'm probably going to hear it because it's likely going to fill. This is a liquid enough product. It's that exchange designated limit order is probably going to work fairly quickly, but that's not always a guarantee. So I want to make sure that I'm aware of that. And I'm going to go ahead and I'm going to create that alert up here at that level so that if this does go up through that level, I want to know about it. And it's headed that way now in this first 5 minutes of the day, or first 5 or 10 minutes of the day. We'll see if that reverses. We might have picked the wrong direction here. Sometimes that happens, but again, that's the reason why we have those orders and alerts in place to take advantage of that possible movement. Now, going to the downside, if this does start to move to the downside, I mean, I think realistically, that's why I drew this line here at about the 64 mark. That's kind of this next level of what was previous resistance, potentially support. That's a pretty big move to the downside. Now, today's Wednesday, so we're going to have, today's Tuesday. Tomorrow, we're going to have EIA numbers in terms of crude oil inventories and those types of things. And so we're also in the middle of trade talks with China, and so that's going to have an impact on gasoline and oil and energy demand. So we might be seeing this push to the downside. We might be running into this resistance. That's kind of the basis behind this particular trade perspective. Now, let's jump out. Yeah, and you're right. So there is a risk to volume, right? And this is intended potentially, Bill, and I kind of did this on purpose, because this is intended to be a pretty short-term trade. And as a matter of fact, if we go to the trade tab and we look at all the products, we can see that this has 8 days to go. We're not really yet starting to see volume rolling into that second contract, right, to the next deliverable, which is the August. As we get towards the end of this week and into the beginning of next week, we're going to start to see that volume picking up in the Q contract, not the N contract. It's going to be rolling from the Q or from the N to the Q contract. And so, Bill, great question to ask. In fact, we're going to roll one of these contracts that we already have in place for specifically the scenario that those contracts are moving from the active contract to the next contract. And for those of you that were in the Anaheim Advanced Options workshop with us, live workshop a couple of weeks ago, Kevin Hinks and I talked a little bit about this, about the idea of rolling that contract and getting into that deliverable. So the mythology is that if you were to let a contract go all the way to delivery, that you're going to end up taking possession of whatever the underlying is in the futures contract, right? So you're going to get bushels of corn, or you're going to get barrels of oil delivered to your house, and the answer is no, you're not, because at Schwab, in terms of futures, there's not physical delivery. George, yes, you're right. So as we talk about this, and as a matter of fact, I mentioned this as we were looking at the chart in terms of the geopolitics, right? So that EIA number is going to reflect geopolitics. We talk oftentimes about OPEC meetings in that context. We'll also talk about the fact that, remember, I mentioned that we're kind of in the middle of trade negotiations with China. So that part of the geopolitical perspective is a part of the discussion. And there we go. So we bought it back. So we got kicked out of that trade right away. Now, what I'm going to do is I'm going to come back and I'm going to cancel those two alerts simply because it's now starting to rally pretty specifically. And I don't necessarily want to be reminded of the fact that we took the wrong position. We took the opposite position of the direction that the price of the contract moved. And sometimes that happens, right? I mean, that is a real possibility. Now, here's the thing. It tagged it, and it's coming back down from that resistance level. And so that's where that resistance level is, from a technical analysis perspective. So what I'm going to do, because I think there's still potential for this to make that move to the downside, is I'm going to come back in here and I'm going to place a sell stop order, right? So I still want to trade this to the downside, right? So I'm going to right click and we're going to create a sell custom. So we're going to sell this with a stop, but we're going to make this a sell stop first in order to get into the trade, right? So we've talked about making buy stop orders in getting in when a trade or when a price level is crossed to the upside. This is going to be a sell stop. So we're going to change this order to a stop. And we're going to say, fine, stop. Don't get into this, because this first order, normally we're used to using sell stop orders in equities and options as a means to exit a position. This is still going to be a position to enter the trade. So I'm going to say, look, if this breaks back down below 65.51, where that support level is in this particular case, so if this breaks below 65.51, and I'm going to make it actually 65.50 as our stop, I want to get into the short position on this futures contract. But I want to stop it out again if it goes back to the upside. So this is going to be a first triggers order. And I'm going to say, fine, if it goes back to the upside, get me out at, again, 65.75, but I want to get in at 65.50, right? So 65.75 is up here. 65.50 is down here. If this goes down, I want to make it move down through that level. Yeah, and oil for sure does, right? Fluctuate this much on a daily basis, or it can. I mean, this is, okay, I'll use the pun. This is a liquid contract, number one, and it is a liquid market, meaning it moves and it is an actively traded market. So we're going to put this order in. I'm going to put that in as a good till canceled once again on our buy stop order. So we've got a sell stop to enter. We've got a buy stop in this case to exit. Now, both of those are going to issue market orders, and both of those are going to be worked as exchange designated limit orders. So be aware, there's the possibility that one or both of these orders, as they are initiated, because this one has to trigger first, then this one would be in place. There's the possibility that both of these orders could end up, well, if the first one didn't fill, this one won't be even an issue, right? But if this one fills, then there's a possibility that this one wouldn't fill if, in fact, it gapped through. This doesn't tend to be a gappy contract, but in fact, if it gapped through that break, there's a possibility that order would not fill and exit. That's one of the things that we are willing to accept when we place those orders, right? We have to be, that there's the possibility that it doesn't get filled. So I'm going to go ahead and I'm going to click on confirm and send, and we're going to be looking for that break back down to the downside. And again, there's a possibility that this order does not get filled. Our initial order to enter the position, which doesn't occur till down here. So this has got a long ways to go to the downside. But again, we're looking for this to make that move to the downside. And, so if we think about it in terms of that move, right? So let's think about what, if we were just targeting the down here, right? So that's 65 to to our support level here at 65.12. So 65.50 to 65.12. So what I'm going to do is I'm going to come back over here, right? So that's not a full point move, but we can look at it in terms of our tick value, right? So tick values, that's this minimum increment. So if we went from 65.50 to 65, we were looking at potentially getting out of the trade if it made that move down to, we saw at 65.13. Let's just take 65.13 and what that profit would be. So 65.50 minus 65.13 is 37 ticks, right? 37 ticks in this particular case, right? Because remember, tick is this increment right here, that digit right there. So what would we make if this made that move just down to 37? Or excuse me, just down to 65.13? $37 in the contract, right? Small loss, right? Or small potential gain, but again, we're talking about the micro contract here. So that's what we've got to do, right? In terms of calculating that is look at our tick value and the number of ticks that we expect it to move. So small contract, small trade. But again, there's a reason why I'm demonstrating the micro contract as opposed to the big contract. If we were to change this to the big contract, right? So 47, let's do /CL, that big contract, each tick. So same tick size. So that would be 37 times 10, right? 37 times 10 instead of 37 times 1. So $370 on the big contract. But our initial margin in initiating the contract, the big contract, is significantly larger, right? So we click on the drop down arrow, we go to futures, and we see /CL, and our initial margin is 57.16 as opposed to 517, right? Or 571, excuse me. So we had one contract in this particular case. So we saw a small loss, small potential gain. Again, that's kind of the basics to get us started in this process. So we're going to come back over here. We're going to do /MCL, and there's our, no, we did one contract. Our default in this particular case is one contract. If we were to increase it to 10 contracts, so if we were to create that order, let me just do that really quickly. So let's create that order again. So we'll just do a sell order, and I'll just put this in as a demonstration, right? Here's our sell order. Notice our initial margin, 574, right? But if we did this order and we went, okay, let's do a sell order, single, but let's edit the size of this order and let's make that short 10 contracts. There's 10. We click on confirm and send. Now our initial margin in this particular case is going to be exactly this. So here's the difference. Here's our initial margin, right? That's that same initial margin as the large contract, but notice what our transaction cost moved up to, right? Because that's a per contract. So we times that by 10. So now we're talking about slippage of 22, or transaction cost of $22.50. But here's the thing. What if we had done this? What if instead of /CL, and what if we had initiated the same kind of position here, right click, sell single, let's come down and edit that order, and you can see there's our initial margin, edit the order, one contract, and we click on confirm and send. Now our transaction costs are a lot less. So it's really how you decide you want to do it, right? If you wanted to do 10 contracts with the micro, your transaction costs are going to be higher, but your initial margin is going to be about the same. So if you're going to trade the smaller contract, right? Yeah, if you're going to trade the smaller contract, then you might want to keep those position sizes smaller simply because, so be aware of that. So how you put the trade together in terms of the size of the contract versus the number of contracts to get to the same thing. Now there's one benefit though. and think about the other side of this coin in the interest of being fair and balanced. This is one contract, and one contract gives us one shot to exit the position. So what you could do is you could categorize this as, okay, I have a one and done scenario here with one contract, meaning I can't scale back my position, but I'm paying less transaction costs for it. With the smaller contract, if you were to add more contracts to be an equivalent number of, or equivalent amount of initial margin, you've got 10 contracts, your transaction costs are higher, but you have scalability. You can sell some of those contracts, you can buy some of those contracts back, and that's maybe how you think about what you're paying. You're paying that fee to have scalability, maybe is the way to think about it, right? In terms of one versus the other. Okay. So that's kind of how you might go through that process. Great question. I don't mind going off on tangents about that type of discussion, because I think that's relevant and important information. So let's do this. I want to pop over here really quickly. We're going to pop into our futures grid. I just kind of want to see what's going on around the space today. The ES moving a little bit higher, but kind of a doji candle today, a little bit of a spinning top, perhaps some equilibrium. Same thing with the NASDAQ running into some equilibrium right here at this resistance level. The Russell 2000 a little bit stronger. And the reason I wanted to look at this is because if we go over to our monitor tab and we take a look at our group of stocks, we were using /M2K not only to beta weight our portfolio, but we were adding that long position in the /M2K, which is the micro Russell 2000 futures, the small cap futures. Remember, we said the majority of the stocks in this list are small cap stocks. We can see their sensitivity to /M2K. If I were to take this position out just temporarily, so I'm going to just put this here in our temp group, you can see that the beta weighting for this portfolio of individual stocks is about 48 deltas when we put them in equivalent deltas of the M2K. So this is a fairly directionally sensitive portfolio, meaning it's got lots of long deltas here. Not a huge amount of long deltas in terms of this contract, but a fair amount of long deltas. And we put on this position to add to that. Remember, we said the Russell 2000 is moving higher. So we were going to put on this futures contract. No, normally what we would do is put on an opposite order, meaning we would sell an M2K contract to reduce this number of deltas. But we were putting this contract on as a means to augment or amplify the number of deltas that we're seeing here. So we went from about 48 to about 53 deltas. This contract adds 5 deltas. If we were going to add to that, we could add another contract and we could amp up that delta number as well for the portfolio. The problem is, right? Leverage cuts both ways. So it's working for us as long as the Russell 2000 is continuing to move to the upside. Working against us because it's now increased our delta sensitivity if the Russell 2000 were to start to turn in the opposite direction. So that becomes a potential issue, right? And so something we've got to keep in mind in terms of using a futures contract. It can be a big hedge. It can be a big blunt hedge. It could be a more surgical hedge here in terms of using the micro contract, or it can be an augment to the performance of the portfolio, right? Because if these are all small cap sensitive generally, and we've added some deltas to this that are small cap deltas, that means that this portfolio overall is benefiting if the small caps go up, right? So that's kind of the other side of use of beta weighting here as opposed to hedging. We've talked about hedging quite a bit. I talk about hedging a lot in my Wednesday index options webcast as well. And we talk about using index options as a means to hedge, but this is another way to do that that doesn't have the time decay of an options contract, because this, even though this has an expiration date, right? And the expiration date or deliverable date for this contract is 10 days away. There's not a theta component to this long, in this case, long /M2K Russell 2000, micro Russell 2000 contract. It doesn't lose value simply because of the passage of time like an options contract does. Okay. Now, I'm just going to say this. I know I mentioned the word options, but just to make sure that you are aware, remember that options are also leveraged products. They carry a substantial amount of risk. They are not suitable for all investors. Make sure that you are, if you're considering trading options, like index options or equity options, make sure that you read the characteristics and risks of standardized options. Make sure that you're aware of those risks before considering any option strategies, just so that's disclaimed and you're aware of that. All right, so the other one that I wanted to look at here really quickly while we were here is this one, /SIL. And this is moving in our direction. And it's been moving in our direction for a little while. So I want to come back over here to the charts and take a look at /SIL. We put this trade on last week. It's been moving in an upward direction. It's pulled back a little bit. So what I want to do is, I still have time in this contract. I don't need to roll it, but we're talking about rolling another one here in just a minute. But take a look at where this candle, so these are daily candles, where this is perhaps establishing a level of support. And I don't want to give everything back that I've made in the trade, but I'm starting to see the RSI turn a little bit to the downside. So what I'm going to do is I'm going to go to the base of this candle right here at about the 36 mark. And I'm going to right click. And I'm going to put on here an alert. And I'm going to say, if this marks at or below 36, then I want to know about it, because I want to look at potentially taking the trade off in this particular case, right? So I'm going to leave this trade on because it's still moving in a bullish direction. Even if it bull flags a little bit, that's okay. This is a little bit longer trade. Our expectation was, if this continues to move higher, great. If it doesn't, we'll take the trade off. So I'm going to go ahead and I'm going to create that alert, and that alert is in place. Now, we could put a stop order in there as well. I've chosen in this particular case to leave that stop order off, because I know that that's going to get worked as an exchange designated limit order. I want to use this alert as a means to let me know, then I can make a decision. But there's a moral hazard to that, right? The moral hazard is I've got to do something if I get that alert. So what if I miss the alert? There's a possibility that I could miss that trade. Okay, so I want to do two things here. Again, to kind of, as we're coming down to this mix, I want to go back to our monitor tab. And it was this M2K contract that I wanted to adjust. So here we are, 10 days to go until this contract expires. So I'm going to go to our / not CL /M2K. And I'm just going to demonstrate this, because we're starting to maybe see, and we're maybe a little bit ahead of this, but these are longer delivery dates than the crude oil contracts. So there may be a tendency for traders in index products to start to roll their contracts to the next deliverable maybe a little bit earlier, because there's a longer lead time in those contracts, whereas in the crude contracts or those energy contracts, we were talking about monthly deliveries, right? So this has basically quarterly deliveries, right? End of June, end of September, June 25th, June deliverable, September deliverable, December deliverable. So these are quarterly, basically, deliverables, right? So these are 3-month contracts. So what I'm going to start to do here is, because I've got one contract, we're just going to do this. I'm going to do this for demonstration purposes, although we could wait till later in the remaining 10 days to roll this. But I wanted to show you how we were going to go about doing this. So I'm going to go back to my monitor tab, and here's the contract, and I'm going to right click, and it's just like rolling any other position. A long stock position is like rolling an options contract. This is not an options contract. Remember, there's difference. Be aware of those risks. But we're going to create a calendar spread, essentially. Calendar spread comes into play here simply because we are buying, or actually selling, the one that we're currently long, and we're buying another one, right? Because we're currently long this contract. So we're selling one and buying another one. Now, the problem is there's going to be a pricing issue here, right? So when we create this order to buy this one back, or excuse me, to sell this one back and then buy another one, if you start to take a look at these last prices, you see that the current contract, the most active contract, is priced at $21.62. And the next contract out is priced at $21.79. This is the normal relationship that normally what's referred to as contango is the normal relationship of prices, right? That future prices out into the future are a little bit more expensive because there's carry costs and because there's a future expectation of larger movement. So normally you're going to see this curve look like this, in that your next month's out or your next contracts out are going to be priced a little bit more expensively, which is the reason why I'm not necessarily going to initiate this trade right now. I just wanted to demonstrate it and show you what this looks like. Because in order to create this role, we're going to have to pay for this role. If we click on confirm and send, we're going to also have to pay for that, that transaction cost. Now, the challenge is, in this particular case, in terms of doing that role, you've got that difference in price. And so we're going to, this isn't necessarily going to be a debit in the way that we would think about it in terms of an option role, but it's going to come out of our futures account in terms of our value that we've made in the trade, or that so it's going to get debited or credited against our account, but it's not specifically. So if you look at this, when we click on confirm and send, it's not the same type of accounting as we would see in an option contract from that standpoint. Does that make sense? So we'll come back and we'll initiate this role, but I just wanted to start that demonstration of how we would initiate that role from one contract to another, since we brought up the question earlier. Now, the last thing I wanted to do here really quickly is show you something else on the active trader grid. So what I'm going to do is I'm going to go to the trade tab here, and we're going to take a look at, I want to go back to that contract /HO. We've looked at it before. This is heating oil, since there was that discussion of heating oil before, and I want to go to the active trader grid for heating oil. So I'm going to click on active trader. We've put this, and we talked a little bit about this last week, in terms of how we would put this order together and how we would use this tool. And remember, this kind of gives us that time and sales view of where those orders are and where those prices are. Where the current price is, you can see this 2.15. That's going to be where this highlight is in the active trader ladder. We've got those big buttons, buy and sell. But what I've also got on here, since this is a 5-minute chart, I've got on here a 20-period moving average. And what I wanted you to see on this active trader ladder is the synchronization. And you can do this in the customize gear right here in how you customize this tool, but I can show where that moving average is, or where a particular study on the chart is on the active trader ladder. And that can be a helpful tool in seeing whether or not you are placing an order above or below a particular level. So let's do that. I know we were looking at silver before /SIL. Let's take a look at silver. Silver is making that move to the downside. So maybe we look at getting into the trade. And what I'm going to do, so I'm going to do a real quick order here using a bracket for a specific reason. And the specific reason here, I'll use the larger contract for this, just for the sake of this demonstration. Now, initial margin is going to be larger, notional value is going to be larger, but if you wanted to create an order that had say for instance, a 2-to-1 reward to risk ratio, right? We can use this trigger with bracket template. And the way that we get that is we click on this little down arrow right here, and then we're going to see those templates, right? And so we can use a single template. That's a single template, but I'm going to use this trigger with bracket. So once our order fills, this bracket order is going to be in place. So what if I don't want to specify and calculate where those levels are to create those specific orders? Well, so what I can do is I can come up here and I can say, look, I want to make this let's make this 2 if I'm going to go long this contract. So I want to make that 2 and 1. So it's going to stop me out 1 level below, and we can use this as either ticks, we can do percentage, or we can do a price level. All right, so +1 +2 or -1 +2, and we're going to create a 2-to-1 reward to risk trade here in this particular case. The market's sitting right here at about 36.625. So if I want to buy this order, I'm going to just simply click right here where that order currently is. If I put it up here, that's going to be with a buy stop. If I put it below the market, it's going to be at a buy limit order. So the market is currently right here. I'm going to initiate that order, and we're going to see where that +1 or +2 -1 is. There's our transaction costs, and we're going to go ahead and we're going to click on send. And you can see how that order then is put together. And it filled for us because we bought it right at the market, and that order filled. But now that's going to put, if we go back to our chart for /SIL, actually we did the large contract, right? /SI. And if we did show orders and click on apply and OK, now you're going to see where those orders are. So here's our stop, and then here's our limit order to take profit in the trade. So I did that really quickly. We did that using the Active Trader ladder. We'll dig more as we go along, and we're doing just little bits of this every week. We'll learn more about that Active Trader tool. But if you want to learn more about it, this is a great place to go. Remember to click on subscribe and like if you are on this page. You can do it down at the bottom right. You can go to the Trader Talks webcast page and click on subscribe. No cost to you, and it's a great way to stay connected to this community. But if you type in the words Active Trader, then you're going to see webcasts like placing trade orders faster with Active Trader, Plan, Click, Trade, a guide to the Active Trader tool, Brent Moore's The Basics of Active Trader Tools, Understanding the Active Trader Ladder, Understanding the Active Trader Tools. Barb uses it in trading a smaller account. So lots of great resources to be able to see how to better use that Active Trader Ladder. And we're going to do a little bit more with it next week again as well. So my thanks to all of you for joining me. This is a great place to be. If you like learning about trading futures, do me a favor, click on that like button down at the bottom of the page there. My thanks to Michael Fairborn for helping out today. My thanks to our great production staff. And of course, I cannot forget our reviewers, Mindy and Nikki and everybody else that helps to review these webcasts and make sure that everything gets out to you. Thanks to everybody. We'll see you again very soon later today. Have a great day. Take care, everybody. Bye-bye.